the best companies and those that actually do end up raising, and not just one round, but multiple rounds, are very good at articulating what is the pain point they're trying to fix.
So, how do you determine the size of the market for them?
The effort that I see in the Saudi capital and in the kingdom, across the kingdom, but especially in Riyadh, is unprecedented.
And next 5 years would be the key, according to
It's not black and white, but I would say in the stage we invest as pre-seed and seed fund, the team is the key.
How do you identify the best team? Like, are they able to change? And do you interview or how do you talk and how do you identify?
A year from now, which is an eternity in venture capital terms, that technology may be obsolete, meaning you cannot charge for it, or it may be easily replicatable by many others.
Around 75 to 90% of the startups fail. And the question is, with the high failure rate of startups, does venture debt provide a more secure path compared to traditional equity? Hello everyone, I'm the founder and CEO of Morse. We help startups in fundraising, helping them to scale and innovate. So this is our first digital broadcast. I'm happy to announce our guest today, Mr. Ivo. He's a venture partner at Oryx Fund. I'm glad that we are gathered today here. So we're gonna understand what goes with the VC mindset when they are selecting startup for the fundraising and when they are deciding about them, and also about the landscape in MENA and globally. It will be a very interesting conversation throughout. I welcome you, sir, here.
Pleasure.
So globally, we see like the venture capital funding is reaching around $370 billion in 2024. How do you choose the best sectors to invest in?
Actually, we did reach apparently 370 billion in 24. Small increase on the year before, 5% or so, 350. And not surprisingly, globally, artificial intelligence startups attracted approximately 130 billion of investment capital. So that is roughly about 35% of the total number went into AI related startups. That marked a 50% year over year growth in those particular startups in AI. And in the US, the most developed venture ecosystem, 50% of the deal value was actually in AI. So that tells you that we clearly have a new winner. And, you know, this is a very, very interesting space. The AI functionality is something that creeps into every pitch book today, into every investor presentation. And this, follows not dissimilar trends to other technologies that have come over the recent years, blockchain, Web3. More recently, we've been very, very keen on SaaS models, etc. So time will tell how this will play out, but we do confirm that most of the presentations we see today have AI functionality in the company's tech stack. So having said that, we don't think we should be looking at AI in some sort of isolation. We continue to like traditional verticals that now are actually better with the emergence of this AI functionality. So we continue to look at fintech, education, healthcare, logistics, increasingly construction tech, etc., consumer tech, that now has the companies in those verticals now have the AI functionality in their tech stack, and it is our job to determine which ones actually can have a billable model for that AI functionality, because some of that functionality may end up being free or easily replicated, meaning those business models may or may not be sustainable. And it is difficult because we do have very, very quick development in the AI space, and we also have to differentiate between hundreds and thousands of presentations and conversations we're having, all of which claim such AI functionality. But it's very interesting, it's very serious, and very useful exercise.
Thank you, Ivo. As you mentioned, we are coming across a lot of AI-based startups. So, how do you identify which startup is more into the game or they have skin in the game? What is the criteria for identification for you or
I
for
mean,
your
if
investment?
you're asking the question in general,
Yeah,
by definition, the
yeah,
startup founders have skin in the game because they own the majority of the equity. So that actually comes almost definitionally. We, the venture capitalists, are significant minority as a group on the cap table. If you have three VCs, they would probably, as a group, own 25 to 30%, and that is the number I call significant minority. But each of us would be something like 5 to 10% in the equity of that startup. The remainder, 60, 70% in some cases, is owned by the founders. So that is your skin in the game. Our founders basically are very exposed to the success or failure of that startup, and that is skin in the game, if I understood the question correctly.
yeah, yeah. So the question, one part of the question was, what is the, because every startup claims they integrated AI into
I
that.
see what you mean. Yeah. Hmm.
So, what is the criteria for that? Because I'm personally, I'm coming across a lot of startups and they have AI they integrate, or sometimes they claim like they are integrating AI into the functionalities. So, what is the criteria for you as an investor and as a VC? How do you shortlist some of them for
Yeah.
the
Yeah. I mean, we need to understand where that AI functionality actually resides. Where is it? And what enables AI is two things, mainly a lot of time series data that is accumulated over time. It is now available because our region has done amazing job digitizing over the last 10 to 15 years, and processing power. And of course, that power can be as a result of an open model or a closed model. So we do have the components. What we don't have is the crystal ball to tell us whether everyone can do what you are doing today. So we can unfortunately assess them very, very much in the context of today, but not necessarily in the context of tomorrow and a year from now, which is an eternity in venture capital terms. uh, that technology may be obsolete, meaning you cannot charge for it, or it may be easily replicatable by many others. So understanding that the founder is equally anxious, rather than pitching their current AI edge, which they may or may not have, is important, because this space is not static. It is developing very, very fast. These models become better and better. They do add a lot of value. The question is not whether the model is amazing today and whether it adds value today and whether it improves someone's productivity or decision making today. more often than not, the answer probably is yes. The issue is, if you're planning to charge for it, can you do that in 2, 3, 5 years from now? And 5 seems in a very, very long period of time at the current pace of development. So that is actually what we are trying to get our arms around. In the end, you need to have a good business model with or without the AI component to it. So AI is, if you will, the gravy, but actually you need to have a good logistics model. You need to have a good fintech or health tech model to begin with, robust, and then on top of that, you may position yourself as having an edge, having this AI functionality in your tech stack. But the risk there is that it may become obsolete, i.e., free, and you may not be able to charge for it, or it may be replicated by many. And so, including actually your clients may themselves develop an AI solution. So that also could be something to take into consideration. It definitely isn't easy, and I think colleagues globally that may jump on the bandwagon may realize that these are free solutions in the end.
Around 75 to 90% of the startups fail.
Mm-hmm.
And the question is, with the high failure rate of startups, does venture debt provide a more secure path compared to traditional equity?
I mean, I would say the opposite, actually, because venture debt comes with an interest expense, periodic interest expense. That interest expense usually is tied to the trajectory of your revenues. So, very simplistically, the higher revenues you generate, the more debt repayment you're required to make. The lower the revenues you generate in a particular month or quarter, the less you repay. And of course, the extreme case, if you generate zero, you repay zero that particular month. So it's a flexible product, but it does come with interest expense, no doubt. And you need to repay the capital back. The benefit, of course, of venture debt is that you get no dilution. The flip side of uh, equity, for example, is you do get dilution, but equity does not make you bankrupt, meaning there is no bankruptcy risk in taking equity, investing it poorly, and running out of cash. I mean, yes, you can go bankrupt by purely running out of cash, but there is no periodic payments related to equity because we don't charge dividends as equity investors. Orex is an equity investor in companies. But equity is, if we say that venture debt may not be cheap, equity is more expensive. So equity is more expensive because it's at the bottom of the cap table. We are at the bottom. We are practically with the common shares, because usually we would invest in preferred at the bottom, and there may be multiple layers of debt and leases that sit higher than us on the cap table. And that is why equity in venture generally comes at 20-25% cost, whether venture debt may be low double digit all the way up to teens in terms of cost. Of course, I'm trying to generalize here, but I wouldn't say that venture debt necessarily makes the cap table of a startup less or more risky. Actually, the optimal cap table probably should have a mix of the two, because for some companies that are already starting to generate, let's say, good SaaS revenues, venture debt would make a lot of sense up to a point. Of course, you cannot only probably finance yourself with venture debt alone, because you expose yourself to not being able to pay the risk. And that is a joint decision between the founders, their advisors, if they have any, and the venture debt provider. for example. And then companies should not avoid venture debt altogether and take equity, because that will result in maybe unnecessarily high dilution. So I don't think that the answer is necessarily black and white, and I think a mix of both probably makes sense for most companies, but not all.
What will be the right time for startup to decide whether they have to go for debt financing or
Yeah,
equity financing?
yeah.
What will
I
be
mean,
the time?
equity from day one, because equity is basically, you know, at the very early stage, equity can be viewed for those finance geeks that may be watching like a call option, because we invest not a significant amount of money initially. We, as the pre-seed and seed stage funds, 250,000, $500,000, and that could be viewed as, you know, like a call option, which may become in the money, or it may expire worthless, and you recover zero. So equity, I think, for the first at least 2-3 years is probably the only source of capital. And then venture debt, you need to have predictable revenues, and that's not advice that people should take from me. They should take it from the venture debt fund, because the venture debt fund would look at historical revenues. I would say at least 1 year, but ideally two. So you're a slightly older company in terms of your profile, and then you need to have some sort of predictability in your revenues, and that is what the venture debt fund manager wants to see. I don't think that I can tell you definitively what number that is, and whether it's a million revenue a month, and what currency. I mean, these are, but predictability is good. Something that shows some modest growth, but predictability, because the venture debt fund manager thinks, can I get my money back? And they probably, again, I shouldn't be speaking on their behalf, are not interested in 100% month on month growth. They're interested in predictability of the monthly revenue. So, whereas we would be delighted to see 100% month on month growth, with, of course, the commensurate risk that comes with such growth, because you could very quickly run out of cash. So, I would say year 2 or 3. And then if you're a SaaS business, to show growing ARR will probably make you a great candidate for venture debt.
Yeah, makes sense. Sustainability investment grew by over 20%.
Yeah.
And how is your VC firm, Salica Oryx, making its investments more eco-friendly? What
Yeah.
is your strategy?
I mean, we are a, a traditional VC. We're not a sustainability fund, but sustainability actually comes in many of the presentations we see. And I'm happy to say that we already have 3 investments that are touching on that sustainability topic. One is an investment we recently made in Oman, 4401. This company, very, very interesting, highly scientific, basically takes carbon and converts it into non-poisonous rock. And that process happens deep in the ground, and that rock remains there. So we invested alongside some very, very prominent investors, that gave us strong reassurance that the science actually works. And we were very fortunate, considering our fund size, and considering that we are not, as I mentioned, sustainability fund by itself, to be part of such a reputable cap table, and also to associate ourselves with such a great scientific exercise, capturing carbon, or taking carbon already captured in containers and converting it with a scientific process involving water, uh, deep into the ground, and converting it into non-poisonous rock. So that's probably our most sustainable investment. Baraka, which is a company based out of Jeddah, Baraka is taking excess food from all the known and reputable chains that we're familiar with in our region. Late in the day, a few hours before that perfectly good food is going to be disposed of, and it basically goes to the bin, and revenue is lost. And what Baraka does, without taking any inventory, Baraka actually sells that food into the community, i.e., the current model is B2C, but soon also B2B, into the community at significant discount. So we deliver value to the ultimate consumer. We also deliver value to the food retailer, the food merchant, who is not throwing away muffins and donuts, realizing zero of revenue, but recovers some revenue. But most importantly, for us living in the desert, we actually save that food. We save vast amounts of food, and the merchants that we onboard continues to grow exponentially. And with the B2B model being now in the works, we will be able to also save a lot of grocery just before that grocery is disposed of and goes to the garbage grocery, and sell it to businesses which will use it to cook that food perfectly good and edible, but about to expire, and deliver that significant value to the consumer. We also have a company based in Riyadh, Bark, last mile delivery, and we are increasingly looking at electric motorcycles and electric vehicles. It's not just great for our margins, but it's also great for the environment. And the push towards electric is irreversible. So we are proud that we have at least 3 of our current investments actually very clearly in that sustainability. We will see in our region actually a pretty explicit shift to address environmental concerns, because the region is very much related to carbon, gas, and petrol and coal. And so as our region continues to grow, we will see some notable strides in sustainable investments, but more importantly, government policy that actually supports such sustainable investments as the region moves away from carbon and more into alternative energy, for example. So I think even though we may be behind than other parts of the world at the moment, I think our growth in sustainable focus and sustainable investments is probably the fastest. So we will hopefully soon close that gap, and we will see more and more sustainable investment in large scale projects, government, semi-government, but also in venture portfolios such as ours.
Thank you, Ivo. And I really appreciate you already have 2 investments in one in
3.
Oman, 3 investments. So
Yeah,
one in Oman and probably 2 in Saudi. So
correct.
this is really remarkable. But my question is, what type of startups do you prefer to invest in? Let me explain a bit. If I prioritize or if I rank if I put an order to it, AI, sustainability, green tech, fintech, what is the criteria like? How is the allocation go from your side?
I mean, remember, we are building a portfolio. And so the portfolio needs to be diversified. And a classic venture portfolio is probably, again, take what I say with a grain of salt, between 25 and 30 companies. Of course, there is a range around it. And from experience, ideally, you would know what are the verticals that you want to invest in, and your choice of verticals should be ideally based on your track record in those verticals and what have you done well in those verticals. And they should also, the choice of verticals, I mean, should also match somewhat the deal flow that you see. Meaning, if you were very good at a particular vertical, moved geography, and now work in a different part of the world, and the deal flow is just not there, probably you will struggle. So you need to match factors like track record and available deal flow in your selection of verticals. In the MENA region, we're very, very fortunate that we have some economic sectors that are very, very well developed, such as financial services, logistics, healthcare, education, construction, food and beverage. And if you enable those sectors with the digital transformation that we have been pushing in the last 10 years, and largely I think we have now moved from paper to digital, we're now entering the next stage where you move from digital to knowledge. And we like this analogy. If we assume, and of course there is still probably some work left to be done, that we have largely moved from paper to digital, now we're moving from digital to knowledge. That means that many of the companies in those already existing industry verticals, financial services, logistics, healthcare, education, construction, food, just to name a few, those verticals empowered with access to proprietary data or third-party data and access to computer processing power can benefit from AI functionality that is now available to them. So the choice of verticals needs to basically be something very realistic, something that you will actually see in your deal flow, and last but not least, something that you have experience in and have a good meaningful track record in.
Uh, we see only 20 and 30% of startups secure initial funding, and particularly there's pre-seed, seed, and sometimes they have trouble with the Series A as well.
Mm-hmm.
So, as a VC, what is your advice to early stage startup founders? How they can increase their chances of getting a
I mean,
success?
yeah, we see a lot of presentations. I think, for the current fund, we've probably seen now in excess of maybe 2,500
Wow,
presentations that we
it's a
have
big
we
number.
have logged in. Yes, I mean the usually the investment rate in venture is about 1%. So, you know, ideally, and that's not uncommon, if you have a 30 company portfolio, most likely you've seen about 3,000 companies. Now, of course, you may have seen less, but usually it is about 1% investment probability. What I could say based on our sample, which is somewhere between 2,000 and 2,500, uh, the best companies and those that actually do end up raising, and not just one round, but multiple rounds, are very good at articulating what is the pain point they're trying to fix. Conversely, those that don't do a good job start off a tangent and talk about, maybe other topics like how the team met or the journey to get to the current, point in time, and somehow the pain point you're trying to solve for is lost in that presentation. And I think we really appreciate the companies that actually simple, strong, assertive presentation starts with, here is the pain point that we are trying to fix. Of course, you may or may not believe in that pain point, because some of the pain points are actually affecting very, very few people and or businesses. So of course, point two is we like to see size of the market. And so we like pain points that affect a lot of people as VCs. And then lastly, three, so pain point, size of the market, and three, the team that can differentiate the product, because we do see a lot of repetitive models. Of course, this is normal. And it's a very big market out there. So, if you have multiple companies in the same marketplace, that is absolutely understandable. The team that can actually deliver a narrative in how the product is differentiated. And so that's actually very important. So to recap, pain point, clear communication on what is the pain point you're trying to fix, your market definition, how big is your market, and then having the team to deliver that narrative and explain how the product is differentiated. I think as a gravy, as a very kind of distant, like top four, I would say early evidence of traction would be good, but I wouldn't say necessary, especially for a pre-seed and seed stage fund, because we're supposed to take risks and we are happy to take a view based on very meaningful pain point, large sizable market, and a good team, even in the absence of traction. Because if you have traction, you obviously have to pay for it, meaning the company will probably be worth quite a lot more if there is evidence of traction. But if there is some evidence, that is obviously an added plus. But these would be the four kind of pillars that we look for.
Every startup, I have come across a lot of pitch decks, and every startup adds in a big market, billions, even they are going beyond that. So, how do you determine the size of the market for them? Like whether it is a legit, or should you trust the words that they are saying, or the pitch deck they're saying, like, I have 50 million
Yeah,
market size. So if they say, how would you decide? Like, is
yeah.
it legit or
I
not?
mean,
Or
look, we appreciate the fact that people look beyond their country and beyond their region. This is a very, very good thing. In fact, it's now required, because in the early years of venture capital in the region, probably I would say, 15 years ago, I've been involved in the last 10 of those 15. It was okay to be a national champion. It is no longer okay to be the national champion. It's no longer enough, because the founders have higher aspirations. Technology is very transferable. Most of technology is very transferable. And also, the VC funds, the capital providers, don't believe it's enough to be the national champion. It's just no longer, attractive. That's not to say we won't be investing in companies that aspire to be the national champion, but in our portfolio construction, we would most likely be looking for companies that want to scale outside their market. So to have such aspiration reflected in your target market size is very good. Of course, we have a conversation, actually multiple conversations with our companies, until we determine what may make sense or not. And in the end, our valuation and our offer of a term sheet reflects an adjusted market size. But generally, we very much appreciate it. We like to see ambition rather than not. But of course, we have conversations, multiple ones, with those founders to determine what may be a more practically achievable market size. And in some cases, we accept it. We don't touch it. We don't touch the market size. And we think generally it's a very, very good thing that people have this ambition to sell outside GCC, outside MENA, and why not globally?
That makes sense. But what would be your preference if there's a SaaS B2B versus B2C? What would you prefer? This question is a little off track, but
Yeah.
I came
I
out
mean, I
of
wouldn't say we would look at any SaaS because we like that. Of course, SaaS now is in an interesting place with the existence of the AI
it. Yeah.
functionality and AI agent, etc.
Yeah.
So we will see how that plays out and how that plays out in valuation or even existentially, not just valuation. Uh, I wouldn't say that there is a preference necessarily for B2B or B2C. The reason why we have a slight preference for B2B is the opportunity for that startup to scale in size. Meaning, when you sell to the enterprise, it's easier to scale. But I use easier almost irresponsibly, because to sell as a startup to the enterprise takes a very, very long time. It takes multiple meetings, whether that is a bank or a telecom or a hotel chain that you are selling into. It just takes a long time and many, many meetings. But it's worth that investment in time because the contracts tend to be bigger. In B2C world, I think someone has to pay for marketing, and of course that marketing may be shared by the user of the SaaS or the SaaS creator, the startup. But in a very kind of noisy consumer marketplace, scaling, and of course I'm trying to generalize, which is very dangerous, scaling may be slower for a B2C SaaS model than a B2B SaaS model. So but funds come with their preferences, and we've looked and done investments in both. We just have this view that B2B SaaS, if you get it right, you might be able to scale faster because the contracts being bigger in the enterprise.
Talking about SaaS revenue model, there is some conversation going on around the change in the model, like the ARR, MRR will no longer be relevant for in the long run. I give you my own example. If
Yeah,
I am using an application, I don't want to use that for 6 months or 1 year. Maybe I just need for 2, 3 months.
yeah,
So the transaction-based model would be the ultimate option for people
correct.
to prefer
We
in the
see
long
it in
run.
our portfolio, actually. I mean, some of our founders are saying exactly what you just said,
Yeah.
that, subscription, again, there is always, at least two parts of every coin. Subscription may be useful way to bill your customers in some cases, but transaction based might be a better way, because you can have subscription and then you're sitting on a platform of some sort, and you are dormant. You are not really transacting that month. So that month you've paid subscription for nothing. Then you are really busy, and you are very willing to pay because you benefited from transactions that happened on that platform, and so you may be more willing and inclined to pay a small commission on the transaction volume that was conducted, whether you buy or sell. It doesn't matter. As opposed to you are being charged subscription, but you're not transacting. So it may be more exact, and that means that we will see on income statements not ARR anymore, but GTV, then net revenue, and then gross margin, as opposed to ARR, MRR, and the acronyms that we are familiar with at the
Yeah.
moment. Maybe subscription will become really, really nominal. Maybe $1,000 subscription could become something less than that, for example. But you will also be able to charge GTV. And if you're really adding value, and the only way that can be measured is there are transactions on your platform, then you should be able to charge for that. But that would be GTV related, fee. And that's exactly what you said, and that's what our companies in the SaaS world are saying. So it's basically a search that is going on for the best model at the moment. And that's one of the many interesting trends we see at the moment.
This conversation will be pretty useful for so many startups, early stage and pre-seed and seed, because most of the time they're coming up with the ARR, MRR just because they're worried or concerned like the VCs would not be accepting any other model for them. So it will be a good add-on and reflection.
Well, look, we're all learning. So we will fund projects where we can create value for our own investors. And we are hopeful that we will have a good sample to choose from, because we are capital allocators. We are
Yeah.
not really wedded or looking for a particular technology, blockchain or Web3 or SaaS. We are looking for, if I have 5 years or 4 years or 3 years of time to deploy certain amount of capital in certain region, what are the best deals in that period? Interestingly, the answer to that will only be known 5-10 years from now, when we
Yeah.
look back and say we should have done this, we should not have done that. But we don't have that luxury. So
Yeah.
we're not really wedded to a technology by its title. We are constantly learning, and we're learning together. So I very much view founders and VCs together in the same group when we're all learning. We see, with the emergence of AI, all the pitches now include AI either in the title of the company itself, or
Yeah.
in the product, or in the first few pages of the presentation. That is fine, but we together need to determine which one of we will fund and grow, and which ones we will not fund at this stage.
Thank you, Ivo. Now we will talk a bit about you. You have an incredible journey. You spent your initial time in the US, and then you came to the MENA region. Probably you started your career in Saudi in the MENA. So tell us a bit about you. How has been the journey so far, and what are the key learnings, and what are the challenges you faced here, and what,
Yeah,
what are your aspirations for the future?
if you come into a situation with an open mind, you have very few challenges, because you have a way to understand and rationalize those challenges. So I wouldn't say I've had many or any challenges, whether related to the way business is done, or culture, or climate, or food. I mean, I've really enjoyed everything that I have seen, and I'm now happy to say that I'm part of a very exciting ecosystem for 12 years. My first interaction with venture in Saudi, but Saudi being part of the GCC, was in September 2013, when I joined Riyadh Capital in Riyadh, and we endeavored to create the Riyadh Taknia Fund, or RTF, which became live in 2015. And we invested in, if I recall correctly, 12 amazing companies. That number, um, it was a good selection of 12 companies from deal flow sample, which I recall was significantly smaller than the deal flow sample today. So portfolios, including our current portfolio at Oryx, are significantly larger. We're already at 25, and we haven't finished actually investing Oryx Fund 1 and may add additional names this year. So the journey has been anything but learning, because it's been ever changing, ever developing, and in many cases, our institutions, Riyadh Capital or Salika Investments, have been part of the feedback loop in the region, which can only happen in a region that is open-minded itself and is actually engaging those ecosystem stakeholders as the de facto architects of the ecosystem. So I didn't come into an ecosystem that was already created and I'm trying to fit in and compete. I actually came into a practically non-existent ecosystem, and I don't mean this in any negative way, but a very ambitious, marketplace, and a very ambitious set of regional governments, and we created and continue to create that ecosystem. So you're actively involved, and many of the things that did not exist, we've actually somehow put in place through roundtable discussions or panels at conferences or meetings with ministries and what have you. So that feedback loop is very, very active in our region, and it's actually unique versus other regions, specifically US and Europe, which have older ecosystems and as such somewhat established and static and less changing than ours. So I've enjoyed our journey with the two institutions close to my heart, and we continue to be very active, as are all the other institutions, and more are joining the so-called broader venture capital ecosystem in MENA, with banks, for example, food and beverage companies, construction firms, telecoms, of course, the large oil companies in the region, sovereign wealth funds, ministries. I'm sure I'll miss some. Are kind of joining in, recognizing how important technology is in each kingdom's vision, and we feel very good interacting together. So we will see the result of our work, I think, over the next years and decades, when we create, when the companies we've created will be acquired, creating value for shareholders, but some of which will remain on a standalone basis and become really big firms, driving that change that the region needs and will achieve in the next, I think, 20 to 30 years. What I like very much in the region is the long-term view and the patience. I mean, many people say, well, people are impatient. I have only met patient people. So I like that a lot, and the long-term view and the time you're given to achieve your mandate. That's very important in venture.
Thank you so much, Ivo. I think you are the pioneer in the ecosystem. The way,
One of. I mean, there were others who actually were doing venture and were the pioneers.
yeah,
Very few, I would say. I mean, the first
yeah.
ArabNet conferences were very small events, 100 people, and we celebrated when they reached 1,000, and now we complain when a conference has 50,000 people participating. So we've gone a long way over the last 10 years, for sure.
With this, I will go with the rapid fire questions. Are you ready? Quick.
Hopefully, I mean, I don't know what you have in mind, but yeah, go ahead.
Okay. So, most promising city for startups outside Silicon Valley.
I'm very biased here. So I have to say Riyadh. Riyadh has been, my home since 2013. And the effort that I see in the Saudi capital and in the kingdom, across the kingdom, but especially in Riyadh, is unprecedented. I would be delighted to be involved in the creation of large companies there. I would then quickly move from Riyadh and say GCC as a whole is basically a region that can be taken as a city, competing with the likes of Silicon Valley, London, the cluster between Paris and Berlin in continental Europe, and then Southeast Asia, for example, Singapore. So rather than singling out Riyadh by itself, I would say GCC, because we have, a few cities that are so close to each other that, combined, we should be aspiring to be mentioned up there with the likes of London, Singapore, and San Francisco Bay Area, for example. And that will include, the likes of Riyadh, Doha, Abu Dhabi, Dubai, for example. I mean,
Yeah.
where, each 45, 60 minutes flight away from each other. But yeah, I feel great in Riyadh and seeing what is happening around Riyadh as well.
And next 5 years would be the key, according to you.
Yeah, I mean, we need to see more exits, and we need to celebrate those exits, and we need to start recycling the capital and recycling the initial ambition from, let's say, the 2020, uh, the 2020 post-COVID, for example, ambition that we had, and we saw the emergence of X number of VC funds. Those of us lucky to have a second and a third will need to deliver exits to their LPs, and that capital and ambition meaning renewed enthusiasm, needs to be recycled for the next crop of successful technology companies. I feel in many verticals we're still at the very, very early stages of development, and we will see growth that we cannot really envisage or price today, especially, for example, construction tech, for example, or anything real estate related. I mean, we haven't seen yet the completion of the build out of the infrastructure, and when it is built, we need to have the tech overlay on top of it in order to help with anything, maintenance, selling, investment in it, etc.
Okay, so what is more crucial, a strong team or great idea?
Look, I mean, it's not black and white, but I would say in the stage we invest as pre-seed and seed fund, the team is the key. I wouldn't go as far as saying team is everything, because the team still has to have a good idea in order to execute it. But I would say the relative importance of the team is probably of paramount importance. And our founders, I have thought a lot about it. We have 25 portfolio companies now, different genders, different ages, different nationalities. They are virtually like the same person. They're really strong, deliver the narrative extremely well, picked a big problem, big size, big market size, and they deliver that crystal clear to any audience. They are very quick to determine the level of understanding of the other party. So people who can basically pitch 24 hours and will do well with various audience. So I would say team at the early stage is very important, because the team, if adaptable, can actually pivot. And
Yeah,
pivots are not a shameful things to do.
yeah,
Down rounds is not a shameful thing to do. Pivots is not a shameful thing to do. It's searching for the truth. And
yeah.
these are important elements in that search. A good team can do that. If the team is wedded to an idea which may be good or not that good and is unwilling to pivot, for example, so it's all team, I would say, in the early years, at the time we invest initially.
I will deviate a bit from the rapid fire. A quick question came to my mind. The team has to be adaptive to the circumstances and the
Yeah,
changing dynamics,
regulation maybe. Yeah,
regulations. So, how do you identify the best team? Like, are they able to change? And do you interview or
yeah,
seek right? Like, how
yeah,
do you talk and how do you identify the is this a
yeah.
psychometric test that to
I mean,
apply?
look, you once you have, certain number of companies,
Yeah.
and for me, Oryx One was actually my second fund that I'm involved in. So if we saw 1,000 opportunities with Riyad Taqniya Fund, and now we're at 2,000, 2,500, something in between with Oryx One. I mean, that's a lot of founders,
Yeah.
a lot. And you start to develop a feel, which I haven't been asked to actually describe and put in words, but certainly someone who has very, very clear local acumen, ideally Arabic speaker, because we are a MENA fund. So, you know,
Yeah.
we need that local knowledge, but also is very well conversant, let's say, in the other language, and basically uses them interchangeably. I mean, this is, I would say, very basic because it kind of eliminates the fear. Can this person raise abroad, for example? Because again, we are a MENA fund, but we look at the world much more holistically on a global basis, and we need the three or two co-founders to be able to travel to conferences, represent the firm, and raise from, I would say, pretty much anyone in the world. And for that, you need to be able to be conversant and
Yeah.
deliver that message about the pain point
Yeah.
and about the market size well. You also need to have the EQ to be adaptable, to work with potentially an ever more international team as you open an office in Spain, for example, or in jurisdictions that you may not have traveled to previously, and that you may not have had those in the business plan, for example, because the pace of change in tech is fast, and you need the person who not only embraces it and adapts it, but actually thrives in it. And
Live
to
it.
be honest, over time you develop a feeling. It has nothing to do with just being bilingual. I mean, I started with language just to say it's a very, very quick first couple of minutes kind of determination. Can this person do it as a founder in the US, or to raise in Europe, for example, or Southeast Asia, because it is time now that we push ourselves into that step change and actually say, yes, we are in MENA, but we're building global companies. And that global doesn't mean global domination. It means having more international revenues than MENA, for example. That's global. That's enough, because that opens up doors to investors and opportunities that only 5-10 years ago we didn't think possible. The usual pitch we used to see then, and the usual founder, was basically Riyadh scaling into Dubai or Dubai scaling into Riyadh. This was what we saw. And now we don't have founders that
Yeah.
believe this is attractive or sufficient
Yeah.
to build, and that's very, very good change.
What are the biggest tech trends you expect in 2025, or according to you,
Yeah,
is you gotta be watching that, and your expectations for
I mean,
2020.
I think we will see AI creep into everything. Okay, and I think it will be particularly interesting to see it creep into industries that are very, very ripe for optimization. And I would say construction and anything else to do with completed real estate at the moment is probably done in an inefficient way. So if AI is successful, so AI in general will continue to permeate like water in dry sands, to use desert analogy, into every vertical. So that will be one thing that we can watch and see how that plays out, like AI into logistics, or AI into fintech, or AI into everything basically. So that's one, how AI will be part of the tech stack. And two, particularly industries that haven't historically been, venture driven. And I would single out actually two: construction and slash real estate. So construction is the process of building the real estate before it's completed, but then also beyond the moment of completion onwards. So that is a very interesting area for us. And then food, I think, as well. We are more and more focused on food and sustainability and eating healthy, also bringing down the cost of food, but also keeping all the health elements, etc. So those would be some of the interesting trends that we'll see. Also, another big trend, but it's not really earth-shattering or new, would be embedded finance. Embedded finance, both for individuals and for businesses, is of particular interest, personally, of mine.
What do you mean by embedded finance?
Basically, going into like my bank account or credit card account and being offered, you know, installment plan, buy now, pay later solution as an individual, or you go to a procurement platform as a company A looking to buy product from companies B and C on that procurement platform, and instantly being offered funding for that embedded finance. You didn't go for the finance solution, but it was offered to you, and you're like, "This is great. I'm gonna jump on it and use it." So it's helping me. You go to check your bank account. For example, you are checking your mortgage maybe, and you are offered a better rate to refinance your mortgage. Or you're checking your credit card balance. It's high. You pay, pick your number, 19%, and you have an offer integrated with your bank from a fintech, or from your bank itself, enabled by a fintech, to refinance at 4% or 5%. You immediately jump on it, but you didn't go for that solution in mind. So at the corporate level, embedded finance can be huge.
Um, Go to gadget for business travel.
Honestly, I use travel, I mean, an industry that is, always subject to change. The planes are now lighter, I find, and much more quiet than they used to be. I go to a traditional book, so I actually use the plane time to go back in time, if you will. Uh,
You use.
so I go to a traditional book, believe it or not, and for me, it's really an ultimate luxury to kind of lean back, turn the light on, and read a paper book. I haven't actually transitioned to. I like the flipping of pages a lot.
Mhm.
So I actually don't have a gadget for travel. Of course, my phones are with me. My laptop is with me all the time. Power banks, and I think, um,
Peaceful and quiet.
I mean, I actually don't welcome, to be honest, Wi-Fi and the ability to even make calls in the future on planes. For me, it was the only sanctuary left, and so to have that invaded for me is not necessarily the best change. But I really enjoy flying any length, because for me it gives me the luxury of reading. So I would pick a couple of books, and I will read as much as you can. I have skipped meals in order to read.
We are exceeding the time, but another question. What are your favorite books that you would suggest to others or you like to read mostly?
I mean, I like a lot of business related stuff. I mean, some would argue this is not books with maybe artistic values, but I do like it. It actually challenges my mind, and I think as I read various advice and self-help books, whether this relates to me personally or to my experience as a business person. I like books on investments. I obviously like books on venture capital. I also like novels. I like to follow a story. I'm very much into stories that I can somehow relate to. So that actually usually excludes science fiction. I'm very, very grounded as a person. So I like to be able to relate to the story, and it may be 18th, 19th, 20th century story, but I would like to kind of identify myself, if I can, with one of the characters, or at least know people who can identify with that character. So for me, that connection is important, and that's why I probably never got into sci-fi books, for example.
That's pretty interesting. Pretty interesting. Thanks so much, Ivo. It was
Welcome.
insightful.
Absolute pleasure. Absolute pleasure. Thank you very much, and I'm very happy to revisit what we said, and it may actually be so funny and obsolete 2 3 years from now, if not sooner. Uh,
Yeah,
but
yeah,
yeah,
yeah.
yeah.
But it has been so insightful. Your experience in here really matters a lot and so meaningful for so many startups to connect with. It's a good advice for the founders, and I'm looking forward more meetings with you in the future.
Thank you, thank you very much. Thank you very much. One very interesting exercise I do is I remember from my notes companies we've met, and I look back and I say, oh my goodness, we were so close to invest in this, or very close to invest in that, or we should have invested in this. Uh, it's amazing to actually have the benefit of time and to look at models that we were very close to actually writing a check, and conversely models we didn't write a check but we should have. So it's okay to catch yourself and be wrong, and do this exercise. It's very, very interesting for me.
It's okay to be wrong. It's
It's
okay to.
okay. It's okay to be wrong. Ideally, if you learn, yes, yeah, yeah.
Ivo, I like your advice on this because you're a CFA, Chartered Financial Analyst as well, and I came across a lot of people out there. They're pretty much in the box, and
Yeah.
sometimes they're arrogant, and this is why this honestly the investment bankers are
Is
like that.
this on the venture capital community or founders?
I'm not the founders, but the investment bankers
Yeah,
generally they are like that. But I found you very humble and
yeah.
you very open minded in terms of
Look, in venture, I mean, I'm surprised. I'm a former banker. In venture, you are paid and compensated and rewarded to have an opinion, because you cannot be on the fence, because a presentation comes and you need to make a decision, usually not based on one call, whether to invest or not. Because if you're, let's say, a research analyst and you have buy, sell, or hold, but hold assumes you already have exposure to that stock, nothing is happening, and the research analyst says good things may be coming, because if it's bad things, obviously he or she will put sell rating, right? So buy, sell, hold. We don't have hold option in the VC. We have buy or sell, sell meaning reject, right? So there is no hold.
yeah.
There is no hold. So you cannot be on the fence. Like, we need to decide. And that's what I am reminded by my team, and I also remind my team, myself, you can't be neutral. Which one are you? So some people take that to extreme, and so it's difficult to admit mistake, especially if you are pushing for a deal. And the mistake could be you invested but shouldn't have, or you didn't invest but you should have.
That's a great piece of
Yeah,
advice.
but there is no hold. Hold is luxury.
Yeah, yeah.
So
Great.
yeah, thank you very
Thank
much.
you so much, Ivo.
Appreciate the time and the opportunity.
It was
Have a
absolutely
good Ramadan to everybody listening, and good Eid, and I will see you in April, hopefully.
perfect. We have an upcoming conference in Riyadh.
Fantastic, fantastic.
Thank you so much.
Thank you.